As a real estate agent since 2001, here's exactly what I would do if I wanted to evaluate whether an adjustable rate mortgage was right for me. Because right now, with fixed rates sitting around 6.5%, a lot of front range home buyers are looking into ARMs and asking, is this smart or is this 2008 all over again? And the answer is neither. And the reason is that they're comparing today's ARM to the completely different loan products that blew up 15 years ago. By the end of this video, you'll have a clear framework for whether an ARM makes sense for your situation, and I'll tell you the one mistake that turns a smart financial tool into a liability. Stick around for point 4, because there's the piece that most buyers don't think through until it's too late. Hey friends, my name's Mike Golden with RE/MAX Alliance. I've been working with buyers and sellers in and across the Front Range since 2001. I see these loan decisions play out in real transactions every week. And I want to give you an honest version, not just an optimistic one. Now, most people think they know what an adjustable rate mortgage is. They don't, and the confusion is costing them real money. You see, there are only two real fundamental loan structures: a fixed rate and an adjustable. A fixed rate mortgage locks your interest rate for the life of the loan. Your baseline payment, principal and interest, doesn't move. An ARM gives you a fixed rate for an initial period of time, typically 5, 7, or 10 years. And after that, it adjusts periodically based upon market conditions. A 7/1 ARM means your rate is fixed for 7 years, then adjusts once per year after that. A longer fixed period generally means a slightly higher introductory rate, but more time before you have to make a move. Right now, in and across the Front Range and across the nation, the 7-year ARM is running about 40 basis points below that of a 30-year fixed, or roughly 6.05 to 6.45. And on a $500,000 loan, that's a real payment difference, worth running the numbers through a full amortization and thought process with your lender. You see, the trade-off is relatively straightforward. You're accepting future uncertainty in exchange for a lower rate today. Whether that trade makes sense is entirely about your situation and your timeline. And more importantly, what you plan to do with the difference. You see, an ARM isn't a dangerous loan product. It's a specific financial tool. And like any tool, it works when you use it correctly and blows up in your face when you don't. Now, before we get into whether an ARM makes sense, I want to deal with the 2008 question, because that's sitting in the back of most people's heads and it's going to cloud everything else. Most people keep comparing today's adjustable rate mortgages to that of 2008. That comparison is wrong, and here's exactly why. The ARMs that blew up in 2008 weren't just adjustable rate loans. They were fundamentally different types of products. We're talking about interest-only ARMs, where your required payment covered zero principal. Negative amortization loans, where your loan balance could actually grow while you were making your payments. And they were also handed out to borrowers under ninja qualifications. This was the no income, no job, no verified asset type of loans. Now, these products don't really exist today. They might be under a rock, but primarily they were eliminated by the regulatory reform after the crisis. Today's lenders are required to qualify you at the adjusted rate, not just the introductory one, meaning you have to demonstrate that you can handle the payment after it adjusts before you ever close. More importantly, the risk profile of the modern ARM is fundamentally different than what caused the 2008 collapse. And that doesn't mean that ARMs are risk-free, but the fear that's baked into that comparison isn't based on what's actually available today. You see, the 2008 disaster wasn't about adjustable rates. It was about exotic loan structures and zero underwriting standards. Today's ARM is a different product. So the product itself isn't the problem. The question is whether it's the right product for you, and that starts with the one number that most buyers don't think through carefully enough. There's one number that determines whether an ARM is smart or reckless for your situation? Most buyers guess at it. Here's how to actually figure it out. Historically, the average homeowner moved 7 years, which made an ARM a natural fit for many buyers. But today, that number has shifted. People are staying significantly longer in their homes now, partly because of ultra-low pandemic-era interest rates, creating what's known as a locked-in effect or golden handcuffs. Today, I'd estimate that hold period is probably closer to 10, if not 12 years. What this means practically: if you're planning on staying in the same home for more than 7 years, a 7-year ARM makes sense only if you have a clear plan for what happens on or before year 7. If you're prone to movement, job changes, lifestyle changes, or even potentially a family change, a 5 or a 7-year ARM can work well because the natural timeline aligns with the fixed period. Here's the rules I use with my buyers. Never use an ARM to qualify for a home you couldn't afford on a 30-year fixed. If the only way the math works is to use an ARM to lower the introductory rate, you're buying too much house. It's not a strategy. It's a gap that compounds over time. You see, the time horizon question isn't just how long do I plan to stay, or do I have a real plan for what happens after the fixed period ends. So your timeline will tell you whether or not an ARM can work. What you can do with the monthly savings tells you whether it actually will. Most people taking an ARM to save money every month don't actually save it. Here's the discipline no one talks about. Let's say the average 7-year ARM is going to save you about $200 a month over a 30-year fixed rate. That's real money. The question is, what do you do with it? Because the strategy only works if you actually deploy it. The short version, reinvesting makes sense only if you can find a return that beats your mortgage rate at a comparable risk level. Historically, broad market index returns have exceeded mortgage rates over long periods of time. But on a 5 to 7 year horizon, that carry involves real downside risk. A near risk-free return like that of treasuries or high-grade bonds probably won't even clear that bar either. And if you want to have access to employer matching retirement accounts, that changes the equation significantly because the match is in essence a free return. For most buyers, the most disciplined move is actually the simplest one. Take the monthly savings and make additional principal payments. As a guaranteed rate of return equal to your mortgage rate, it lowers your balance, and when you go to refinance, it reduces your total interest expense. Not exciting, but that move holds up under any stress test. If you want to go deeper on the reinvestment math, that's a conversation worth having with your financial advisor, alongside with your lender. The ARM saves you money on paper. What you do with it is where the strategy comes to play. Extra principal payments are the default smart move for most buyers. Savings strategies matter, but there's one more piece that catches every buyer completely off guard. And it's the scenario you need to model explicitly before you sign anything. An ARM without an exit strategy isn't a financial tool, it's a countdown clock. And here's what that actually looks like. On a 7-year ARM, your rate is locked for 7 years, regardless of what the broader market does. And after that, it adjusts annually based upon a benchmark index, typically the SOFR, plus a margin that is set by your lender. Adjustments are capped, usually at 2% per period and 5% over the life of the loan. But that's still real exposure. Here's the math. A buyer who finances $500,000 today at an interest rate at 6.05 on a 7-year ARM carries a monthly principal and interest payment of around $3,020. If that rate adjusts to 8.05% at year 7, that same loan climbs roughly to $3,630 per month. That's $600 more every month. That doesn't make it a bad choice. It makes it a specific choice that requires a specific plan. Either you expect to sell before the fixed period ends, or you're confident that you'll refinance into a better fixed rate. Both are legitimate exit strategies. But here's the one scenario that catches people. Refinancing isn't guaranteed. If rates stay elevated or move higher, you won't have a cheaper fixed rate loan to refinance into when your ARM adjusts. Model that scenario specifically with your lender before you commit, not after. You see, an ARM can be a smart financial tool or a serious liability. There's a difference whether you have a clear exit strategy before the fixed period ends, not a hope that rates will cooperate. Here's the one thing I want you to take away from this. An ARM is a legitimate tool for the right buyer in the right situation. It's not a relic of 2008. It's not a shortcut for buying more house than you can afford. It's a calculated decision that works when you know your time horizon. Have a real exit strategy and actually deploy the saving. If you're buying in and across the Denver Boulder area, I'm happy to walk through how an ARM versus a fixed rate decision works on your specific numbers. I'll connect you with lenders I trust and make sure they're looking at the full picture, not just the attractive introductory rate. You can find me at mikejgold.com or drop a comment below. And more importantly, if you want to continue receiving information that's financially sound for one of your largest purchases, make sure to like and subscribe. Until next time.